Hi, everybody. It's David Fleming here from the Toronto Realty Group, and happy Wednesday. Hopefully for you. Of course it is. What else could it be now that you're watching part two of my exciting interview with our mortgage broker, Tony Della Sciucca? Hope you enjoyed Monday's video. As you saw, we got a little long in the tooth there, but not my fault. A lot of readers, a lot of questions, a lot of topics to cover, and they're important ones, so we didn't want to do anything half-assed. We didn't shorten the answers. Tony and I, as we get to doing, ended up talking a little bit, some back and forth banter, but always, when we ask these questions, there's experiences, there's stories, there's things that we want to discuss. Often, as you'll see in these questions, it leads to other questions between Tony and myself, so I thought it was fun. Hopefully you enjoyed watching it. Let's queue up part two. Away we go. Enjoy. So Anwar, Tony, next question here. Anwar says, this sounds unoriginal, but I too would love a view into the crystal ball. When are rates going to decline? I think you told us it was.
Yeah, I think on the fixed side, you're probably going to see, if I had to guess, 8 to 12 months. On the variable side, you probably won't see Bank of Canada drop the prime lending rate until, 2024, mid 2024. So again, I want to be clear, when people say drop the rates, we have fixed and variable rates. If people are anticipating, fixed rates to come back to 199 or somewhere in that region, I wouldn't hold my breath. And similarly, we're probably not going to see the prime lending rate come down till, beginning of 2024 or mid 2024, if I had to guess.
Yeah, and Tony and I were talking about this earlier. I was saying that when people refer to rates, you have variable rates, you have fixed rates, right? One works off the bond market, one works off the prime. When people talk about rates going down, I think they're talking about the government of Canada reducing the posted rate, right? And so I think that rates can fluctuate, Tony. Like you can have somebody that's like, I got a 5.29 5-year fixed, and then all of a sudden you say, oh, rates are a little bit better. I got a 4.99. But I think what most people are talking about is they're talking about the government basically changing, are you increasing rates? Are you decreasing rates? Are we in a period of basically doing nothing, which seems to be where we are right now? And so I think, quantitative easing versus quantitative tightening, right? Like they're talking about when is the government going to stop increasing rates? Anwar, I hope that answers that. And we kind of covered that a little bit more. There's probably a few more questions about rates, but we can skim over. Okay, so the next one, Tony, is from somebody called Your Favorite Tenant, which I don't think refers to me and my favorite tenant. I think for sure they're talking about just maybe a sarcastic viewpoint on maybe tenancy and the fact that tenants rather, seem to have all of the rules in their favor. So that, anyways, your favorite tenant can tell me maybe if I'm off base. So this is a long question, but it's an interesting one. With rates for insured mortgages lower than for uninsured, does it ever make sense to switch to a lower down payment and pay for insurance? Does the rate remain insured if a person later switches lenders and or once they have 20% equity? For example, could one make a 19.5% down payment, thus having an insured mortgage, and then, assuming one chooses a mortgage with low penalties, switch lenders and make a payment to get above 20%, switch to a 30-year amortization, getting tired just reading this, and get the best of both worlds, a lower rate and a longer amortization?
I think the short answer is no. And let me be clear, just so that I'm not misunderstanding the question. In today's environment, you essentially fit into three buckets of obtaining interest rates. You have insured mortgages. So that is someone who purchases a property with less than 20% down. You have something called insurable mortgages, where someone is purchasing a property that is under $1 million and is putting 20% down. And then you have what's called uninsured mortgages, where someone is buying a property over $1 million and putting 20% down or more.
Okay.
In the first bucket, the insured mortgages, those rates are significantly cheaper than the uninsured mortgages. And the simple reason is you have to pay an insurance premium to inherit that rate. So that insurance premium ranges anywhere from 1% to 4%, depending on your down payment. But that premium is capped back into the loan of the mortgage. So you're making principal and interest payments on that.
Right.
Second bucket is insurable mortgages. So those rates are slightly lower than uninsured mortgages, but you have to take a 25-year amortization and you have to put 20% down. And then you have the uninsured bucket, which is 20% down or greater. Those rates are marginally higher. I think the question is the insured mortgage space, is there a way to sort of circumvent being in an insured mortgage and then taking an uninsured mortgage? The answer is no. The premium is just too costly to absorb because you don't get a rebate back if you switch your mortgage over 3, 4, 5 months down the road. So it's a sunken cost that you have to pay for that you don't get back. And the math does not work in your favor. So the insurers have figured this out. There really isn't a loophole here.
So they're a little bit smarter than we are, it looks like. And
well, I do this all the time when I try to travel, right? Is I try to pretend that I can outwit Expedia. And I say, can I put one traveler, no wife, no kid, and then it gives me a price, but you get to the resort and suddenly my wife and daughter can't stay with me. So there really isn't a way to sort of circumvent paying the insurance premium and then getting it back if you switch lenders. So the answer is unfortunately no.
I think I remember my first mortgage, I looked at it was like $9 a month. I was like, oh, that's great. But they take the total amount and they just divide it by the number of months in the mortgage. So if I were to sell this place after 3 months, it's not going to cost me $27. I have to pay the entire thing. You said rebate, right? There's no rebate at the end. What I'm telling people here, and your favorite tenant, is that once you sign up for that mortgage, they've got you in that money, whatever it is, whether you're paying it monthly or whether when you discharge the mortgage, you're going to pay that thing off.
Yeah. And the other thing to keep in mind is, once you've paid the insurance premium and you try to break that mortgage 3, 4, 5 months down the road, you now have to pay a breakage fee on that loan, right? So you kind of get dinged twice. The short answer is if you have 20% to put down to avoid the insurance premium, do it.
Okay. So the next one is from Chris. And so we had a blog reader named Chris, who's around forever. Sort of in that, like when Kyle and Chris were kind of dominating comments, Praise are in there too. And we've got Derek, we've got Condo Dweller, we've got a lot of people. I don't think this is Chris because Chris always said things and didn't ask questions. But Chris literally just disappeared. I hope he's okay. He was like one of the top commenters for like 3 years. But this Chris asks questions. He says, what about interest-only mortgages? How do these work? Is it the government that says you have to pay principal and interest? I think he means OSFI. Interest only would help with monthly payments. So can you tell us how interest-only mortgages work and then explain why is it that you have to pay both essentially?
Yeah. So your traditional mortgage that you would get with a bank comes with principal and interest payment. These are set, these guidelines are set by OSFI. We don't have technically an interest-only mortgage aside from obtaining what's called a home equity line of credit. As long as the value does not exceed more than 65% of the value of your home, you can take what's called a home equity line of credit. Those line of credit payments are interest-only payments. And that's really the only product that we have that allows the consumer to make interest-only payments on, what's considered a mortgage in quotations here. But you cannot apply for what's called an interest-only mortgage with your traditional bank. The product does not exist here, aside from obtaining what's called a home equity line of credit. And again, those line of credit payments, you can choose to make interest-only payments on them.
So it's interesting because it's like it's the government basically being big brother. And I don't mean this in a bad way, but let's say that your monthly payment is $3,000. Okay. And let's say rates were a little bit lower when it was half and half. 1,500 is I literally can't talk. 1,500 is principal, 1,500 is interest. Now, 1,500 is being put back into your proverbial pocket. 1,500 is being given to the bank to say, thank you for allowing me to live in this property. That's a big if you didn't have to force this savings, instead of paying $3,000 a month, you're paying $1,500 a month. So just from a liquidity standpoint, I feel like an interest-only mortgage would be great because it would allow people to pay less. It would be terrible because they would never create any equity. And then it would be awful because if all of a sudden mortgage payments were half, everybody would be in the market and prices would skyrocket.
Yeah, and I think you brought a good point here. Like, again, think of it this way. The downside to an institution who's lending you their money is basically saying this, is if you're making interest-only payments and you're not paying down any of the principal, and there's a downturn in a market, which we saw in the beginning of, this year and last year a little bit, and the prices come down 20%, your sunken cost is you have to recover that money somehow, and you're not going to get it from the equity of the sale of your home. So what happens when you sell your home, you effectively are going to owe more than the balance of the mortgage. So as a lender, that's very problematic for them to continue to extend these, interest-only mortgages, because there really isn't an upside to them aside from giving a consumer a little bit of relief in terms of the payment. But they're not in the business of giving payment relief. They're in the business of you making your principal and interest payments on the loan. So there really is no upside to institutions having you make interest only payments.
Yeah, I can see that. Now, are there private lenders that do it, Tony?
Yeah, I mean, on the private side, it's primarily interest only mortgages. So let's say, for example, you have a $500,000 mortgage and you need to borrow an extra 100,000 to renovate your kitchen for whatever reason. You can't qualify with your traditional bank and you can only borrow the money privately. The private lenders have the option to make interest only payments on that loan. And then again, what will typically happen at some point in time is when you can refinance the property, you'll pay back the private lender for whatever the balance is owing. So interest only payments do exist on the private side, but not on the institutional side outside of home equity line of credits.
Okay, good. Okay, so next, the next comment here is from Tony. Did you plant a comment in here?
No. It's definitely not me, unless I want to ask my own question that I don't know the answer to.
Well, it's funny because the last four, it's from Chris, Tony, Mike, Kyle. It's four guys, all with four-letter names, except Chris. Anyways, okay, so Tony says, you seeing more people going to private lenders when need to renew their mortgages or refinance. Sorry, I'm just reading verbatim. Could we get an example of where or why? So what's happening with private lenders for renewals or refinancing? Can we get an example? I mean, I guess he's basically angling for like the guy that lost his job but doesn't want to sell his house that went to a private, or refinancing, somebody needs money and the bank won't touch them. What's here?
So typically the time we get private lenders involved is when you can't qualify with your own traditional bank. And what will typically happen, an example would be the one that I just previously gave, but let's say you have $500,000 mortgage and you need an extra 100,000. You're currently not working, but only maybe one person is working, so you don't qualify for the extra 100, but you have a ton of equity in your home. So in a case like that, you would go see a private lender who's not too concerned about the repayment of the loan per se. They're concerned about how much equity or protection they have in giving you the additional money. And that's traditionally when you'll see a private lender, is when there's enough equity in a home to protect the investor to give you the money. So each case is different, but it could be that someone is currently not working or has a seasonal type of job or is in the process of transitioning work, or just has really bad credit and for whatever reason can't get approved with their, again, traditional bank. So they'll go see a private lender. Ton of reasons, but we see private investors get involved when, the banks typically say, we can't help you. And that's when you'll see a private lender.
So if somebody wants
There's a step in between. We do have, sorry to interrupt this, we do have alternative lenders before your private lenders. So, Home Trust, Equitable banks of the world, they will typically do deals that, your traditional banks won't do. And there are slightly cheaper in interest rates than the private side.
Okay. And so when you talk to a client and you say, hey, instead of going through TD or RBC, I can take you to Home Trust or Equitable Bank. Do you ever get any pushback because people don't know who those lenders are?
Not necessarily. Most of the time when we use alternative lenders, there's a specific reason. So, someone might, be newly self-employed, or there's only one source of income coming into the household, or there's really bad, credit. They have a ton of credit cards and their credit score has been damaged. So there's a specific reason why we try to use alternative lenders versus private lenders. A, it's significantly cheaper, and B, there's a little bit more leeway in terms of approvals versus your private lenders. Private lenders are sort of a last resort for the most part.
Okay. So let's go to our next one. Okay, so Mike says, this is one of those hearsay. My mortgage broker said OSFI is looking at implementing the stress test for mortgage renewals, even if you stay with the same lender. He says, so now he's quoting his mortgage broker, he says that's not going to happen. Can you share your thoughts? So he's looking for a second opinion here. So Can you explain what's the stress test? What happens when you renew with the same lender? And then what is he talking about here with this rumor?
Yeah, so just to kind of preface this a little bit, is anytime someone is either purchasing a home or refinancing the home, they have to qualify it, the stress test. Currently, it's your interest rate plus 2% or the benchmark rate of 5.25, the higher of the two. So in today's environment, the stress test is if you're getting a rate of 5%, you have to qualify as if you can carry the loan at 7%. So that applies, again, to individuals who are purchasing a home and refinancing a home. Okay, so when you have an existing mortgage with your current lender and that mortgage comes up for renewal, the lender presents you with financing options and renewal options with them internally. You do not have to qualify under this stress test guideline with your existing lender at time of renewal.
Right.
What OSFI is looking to do is to say, hey, look, maybe this isn't an even playing field where someone who's buying has to qualify higher, but the person who's renewing does not. So OSFI is taking a look at this and saying, if a person is renewing internally with their own institution, is it possible that they're in a position to renew, or are they in a position where they can't afford those payments anymore? We don't know because they're not qualifying at these stress tests. That's what OSFI is concerned about, is to say, is the person renewing in a better off position or in a worse off position if they have to qualify at this stress test? The answer is we don't know whether this is going to take effect or not, but if I had to guess, I would think that OSFI would probably make this change to make it an even playing field for everybody. But we're not sure whether OSFI or not is going to pull the trigger on this one.
It's funny you said make it an even playing field. I promise I wouldn't get into politics, but it seems like so often we penalize one group because another group has some sort of advantage. We penalize the group with the advantage because the other group doesn't have it. And that is so common in politics. Don't even get me started on healthcare. But it seems to me that it feels like you're saying this person is going to renew their mortgage with the same lender. We don't want them to renew. We don't want it to be so easy on them when other people have to get stress tested to buy for the first time.
And here's sort of true, but here's also what's disadvantageous to the consumer who's saying the institutions know that if you're renewing with them internally, you don't have to qualify at the stress test rate. And what do they do internally? It would behoove them to increase the rate on the renewal rate to keep you attracted and not have to qualify at the stress test rate. So it could be possible that, institutions are charging an extra 25, even 50 basis points on a rate, knowing that you can't go anywhere else. So
now you're talking about consumer protection. I never thought of that before I opened my big mouth.
So to answer the question is, if I had to guess, I would, in terms of probability, I would think it's more than a 50% chance that OSFI at some point in time will implement this policy.
Wow. Okay. So last question here from the reader. Oh, it's Kyle. Okay, good to see Kyle. So Kyle says, now that rates have risen and IRD, interest rate differential penalties, are no longer locking existing borrowers to the same institutions, can we expect to see bigger discounts off posted prime from lenders as competition heats up for the relatively fewer sales happening this year?
So sorry, just to repeat the last part, because I think I just missed you, is can we see discounted rates on posted rates?
He said, can we expect to see bigger discounts off posted and prime from lenders?
I don't think we're going to see much deeper discounts on the prime lending rate anytime soon. Yeah. The short answer is, if the institutions wanted to pass along the savings, I think we would have seen it by now. And if you think about it logically, prime rate is quite expensive, 6.7%. Yeah. If the banks really wanted to incentivize a borrower to take a variable rate, they'd offer something like prime minus 2% or prime minus 1.5%. We just haven't seen it. So I don't think we're going to see these deep discounts until we see prime rate come down. And I probably don't think we're going to see that for the next, 18 to 24 months, maybe 12 to 18 months before we see prime rate come down a little bit. The benefit is anytime you think about breaking a mortgage is you want to just say to yourself, is the interest savings going to offset the penalty that it's costing me to break it? This really becomes a math problem that I tell my clients is, if you're saving more money by inheriting a lower rate, then you do it. If it's costing you more money, then you don't. You continue out the term. So when we look at these examples, we effectively just break down the math and say, hey, look, over the next 2 years of your mortgage, you're either saving X or it's costing you X. When it's saving you money, you break it. If it's costing you money, you stay. And then that's pretty much it.
Yeah. Yeah. And I think, there's my Zoom thing again. I think the second part, he's saying competition heats up for the relatively fewer sales. It's an interesting point because we talk about this in real estate. You say if there's 100,000 sales and there's 70,000 agents, I don't know what the math is on that. The average sale per agent's like 1.3. Now, let's say there's 70,000 agents and there's only 70,000 deals, then the average deal per agent goes down. And so there's always this idea that in down years, everyone's going to be affected. What actually happens in real estate is that the top agents do more deals in the down years. They're not affected, and then more people do zero. So I think what Kyle's saying is there's fewer sales, which means there's fewer deals. There we go. That worked. Did you see it?
Yeah, I saw it. Magic
So
touch.
there's fewer sales, so there's fewer mortgages. So I mean, I guess what Kyle's indirectly asking is like, could we see a rate war to try to attract this business? And it
No.
feels like
I don't think so. Look, I think, there's this perception that low inventory translates to lower interest rates with banks. That's just not the case. They're not really directly related in any way. Again, like fixed interest rates are hedged against off of bond yields, and variable rates against the prime lending rate. So despite what we see in terms of inventory levels, I don't think you see banks, offer these discounts based off of what they're seeing or the data they're seeing off of listings. I just don't think they're related in any way. I think a bank might come out and say, look, our margins to drive up our mortgage business of 100 million or 200 million, we're going to give a discount of $399 for the next 6 weeks. We'll do that. And what you were seeing is you do have institutions incentivizing people by doing cashback mortgages. So, TD Bank has a cashback mortgage, HSBC has a cashback mortgage. But they're not related in terms of interest rate. They're related in the form of incentivizing the borrower to take some additional cash by using their services. So to answer his question, I don't think there's a direct correlation between inventory levels and interest rates and seeing this sort of price war between banks to drive, to obtain new business.
Interesting question. So I wrote down one question I had here, Tony. I'm going to add it on to the end. So David asks, I get a lot of American clients and they're fascinated by this idea that our maximum term is 10 years. Now, I believe that if you were to look at all fixed rate mortgages, forget about variable, just look at fixed rate. I don't know, I would guess 80% of people take a 5-year fixed, even though you can do 1, 2, 3, 4, 5, or 10. I don't know if there's a 7, 8, 9, but it seems like 5-year fixed is the standard, 10 is the max. In the United States, they have a 30-year term. You could lock in for 30 years. Imagine being the guy that at the 2.29% got 30 years. So my question, Tony, is, are there rates different on these 30-year terms? And then why do we max out at 10 and they have 30?
Yeah, I think there's a lot more competition in the US. Banks are privately regulated. They're not, federally regulated. In Canada, they are federally regulated. Also, how the acquisition of the mortgage in the US is a little bit different. So there's upfront costs associated with purchasing a mortgage in the US. So there's a lot of fees up front. And there's no breakage fees when you actually break the term of the mortgage. Whereas in Canada, it's actually the reverse. There are no fees to obtain a mortgage with a traditional bank, and there are fees associated with breaking it. So I just think it's, in terms of how it's structured. So in other words, you're a US consumer, you take a 30-year rate, you buy a house tomorrow, you take a 30-year rate at 6%. 2 years goes by, you want to refinance that loan into a 3% rate. Well, you can do it and pay no fees. Right. Whereas in Canada, there are fees to do that. So I think it's just sort of how the banks are structured a little bit differently in the US. But there are a lot of upfront fees associated with the acquisition of that mortgage in the US versus no fees here in Canada with your traditional purchase. So again, someone buys a house over $1 million, their only cost to purchase that is the down payment that they require and then the land transfer tax and their closing costs. That's it. There are no broker fees associated with those purchases. Where in the US, I believe there is. The fees are up to, I think, 1.5% or up to 3% of the loan that get paid for up front.
So you know what it reminds me of? A friend of mine works at a car dealership, and he said to me once, January we have a sale and a discount on these cars. It's the New Year's door crasher. February we've got another great sale. It's the Valentine's Day, and then in March we have this spring into sales, and then in April, and I'm like, so every month? He goes, yeah, the prices are always the same. We just advertise the sale as something different. So it seems to me that we have the Canadian way, the American way, and at the end of the day, they have advantages, we have advantages, they have disadvantages, we have advantages, but it kind of all probably pools out the same in the end.
Yeah, and don't forget, in the US, you know, the interest is tax deductible. In Canada, they're not. So there's a lot of different components having a mortgage in the US versus Canada. But I've never seen an institution here offer more than 10-year terms, and I wouldn't anticipate that we do anytime soon.
Wow, is that it? Only an hour and change? I think this will be two. This will be 2 videos. I was doing the math on it. I was like, if I do 2 videos next week, when do the TREB stats come out? I won't have them in time to do it on Wednesday, so it's kind of perfect. Anyway, so Tony, thank you for doing this. This is amazing.
My pleasure. Thanks for having me, Dave.
Love answering the questions. And for the readers that are watching this, hopefully you got this far. Any follow-up questions, feel free to post it in notes. Myself or Tony will take a look. And any further questions, it's not too early. We'll probably repeat this again in 3 or 4 months. And always happy to chat. So have a great weekend. Am I going to say weekend? No, you're probably watching this on Wednesday. Enjoy the rest of the week, folks. And I wonder if the Leafs are in the next round by the time you're watching this.
Let's hope. Let's hope. Good luck. Thanks for having me, Dave.
See you guys.
See ya.